Anyone new here who did not attend last week's presentation? So you all know who I am, yeah? Can you talk a little bit? I don't mind a bit of a chit chat. You all know who I am, right? Or you don't? Come on, please. Let's talk.
Yes, sir. We know you.
Okay, good, good. Right. So today I'm going to start off with, now I'm going to do some videos as well for you guys to watch. And it's going to be an interactive session. I don't believe in just talking to you for an entire hour. I will ask you to do some things together. I will ask you to, perform some work with me, and we're going to do things together. Okay. Now, how many of you are from accounting background or have any idea about the accounting equation? Okay, let's put it this way. How many of you have not heard about the accounting equation? Raise your hand or make a gesture on the chat engine, please. So do you or don't you know about the accounting equation? Very quickly. Unmute yourself and let me know if you do know about it. Okay. I'm not getting any responses. Sorry, I need some responses. Do you know or you don't? One of the two. I will assume that you don't in that case. And for the newcomers, please come on camera. I would like everybody to come on camera, please. Okay. Right. Let me just get something up and running very quickly. Right. Let me just share another screen with you. So bear with me. All right, can you all see the screen? I'm going to now share it with you and let's get started, okay? So I'm going to first touch, before we talk about financial statement presentation, we need to talk about what the financial statements are and how they have come together, okay? So I'm sure Professor Charumati has touched some of this, but I'm going to just very quickly go through some of these areas for the purposes of being complete, because I don't want to touch on statements without giving you a background context, okay? So accounting policies and financial statements under IFRS are extremely important and something that we need to look at, okay? So what we talk about, the presentation of financial statements is pretty much this equation, okay? So this equation is what we call asset, the basic equation is what we call assets equals liabilities plus equity. In other words, a company has two components to it. One component is what you call the equity, the money that the owners of the company put into it. The other is the liabilities which the company borrows. Okay, so all of the assets in a company would be a combination of either liability or equity. Okay, is that clear? Right. Then we have the second component of it, which is the income and expenses, which add to the equity of the company. Okay. So what happens here is that we have the income through different business activities and value creation. The company generates income. And in order to generate that income, it forms the part of equity, but there's also expense component that is there that we what's the word, incur when we start generating income. So what happens is income minus expenses become profit, and that profit feeds into both equity and assets. Okay, so it's like a balance. It's like a nice scale. So this side, on the left side, we have assets. On the right side, we have liabilities and equity. All right. Is that clear so far? Do you have any questions there? Anyone? Any questions? All clear? Okay. Now I'm still having some people not coming on camera. Can you please all come on camera? Anyone who is not on camera, please come on camera. Okay. Right. Now, this is my good friend. He's a very old friend of mine, and he's been doing a lot of work around accounting. So I'm just going to play this video for you. He's going to take you through this entire thing. Can you hear this?
Yes, sir.
Elemental. G'day there, guys. My name's Philip Wong. Now, of course, there are 5 elements of accounting, and they are assets, liabilities, equity, income, and, of course, expenses. There are 2 stocks and 2 flows, and one of them is a residual or balancing item. So today we're going to dig into the technical definitions of each of these elements. And yeah, I know that these sound really boring, but it turns out that if you start thinking about these, there are actually quite a lot of instances where things don't quite fit into the definitions, and that's where things can get really interesting. Now, I'm not really one for rote memorization, but it is important that you know these definitions by heart. And let's face it, it's pretty easy, and I'm going to show you how. Now, for each of the elements, the definition is actually split into 2 parts. First off, there is the definition itself, and there's this additional item called the recognition criteria. We're going to start off with assets. So let's say you're looking at a thing and you're not quite sure whether you can count this as an asset or not. Let's say that you work for a local doctor's clinic, and at the back of the storeroom, you find yourself a bunch of old trade journals, magazines, and books. All of these books seem to be about at least a decade old, and you want to know whether you should be able to count them as an asset on the balance sheet or not. To find out, you need to look at the definition of asset, which is found in paragraph 49.
Is the audio clear, Prof? Because there are some students saying you can't hear. Can everybody hear okay?
Yes.
So it is.
Can you quickly? Sorry?
So the audio is a bit weak.
Okay, let me try an alternate method. Okay, bear with me.
The conceptual.
I'll try another way of putting this. Okay, hold on.
Maybe you can increase the volume from your side, Prof.
I got a better idea. It might just work.
There are, I'm going
How's
to show
that?
you how. Now, for each of the elements, the definition is actually split
Is that
into 2
better?
parts. First off, there is the definition itself, and there's this additional item called the recognition criteria. We're going to start off with assets. So let's say you're looking at a thing and you're not quite sure whether you can count this as an asset or not. Let's say that you work for a local doctor's clinic, and at the back of the storeroom you find yourself a bunch of old trade journals, magazines and books. All of these books seem to be about at least a decade old, and you want to know whether you should be able to count them as an asset on the balance sheet or not. To find out, you need to look at the definition of an asset, which is found in paragraph 49A of the conceptual framework. An asset is a resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow to the entity. So let's break this down. 1. Controlled by the entity. 2. Result of past events. 3. Future economic benefits. So for anything to be an asset, it must actually pass all of the criteria. Failing on any one point will lead to derecognition, which is accountants' way of saying we're simply not going to count it. So let's look at a few things here. First off, control. This is not the same as legal ownership. It's usually taken to mean you have the right to sell the asset or do what you will with it. Sometimes you can have something, but it's not legally yours, but economically it might as well be. Say for example, you're an art dealer and the client gives you a painting to sell on an agency arrangement. Legally, you don't own the painting, but it's your job to sell the artwork. You give the funds to your client, minus of course some dealership fee. Here, ownership is not quite the same thing as control. Past events isn't the same thing as a transaction or as if you had bought it. Take for example, if you work in a gold mine and you discover that there are in fact diamonds in that mine as well. Suddenly your mine is worth a lot more. But it's not like you bought the diamonds separately of the mine. You just happened to find the diamonds while you were there. They're legally yours and you get to keep them. Now the act of discovering the existence of these diamonds is considered to be an accounting event, but quite clearly it's not a transaction. Finally, the existence of future economic benefits are taken to mean that this thing, this asset, will help you make money somehow into the future. If it's a block of land, maybe you can rent it out. If it's a bar of gold, you can sell it for cash in the future. It could be even something that might help you save money in the future or simply avoid costs. Take, for example, a fire extinguisher. Sure, you're not going to make any money off having a fire extinguisher, but it will save you from burning your house down. So let's go back to the stack of old books and magazines at the back of the doctor's clinic. We definitely have control since they are, after all, our books. They have resulted from past events since we must have bought them or someone gave them to us. Maybe a friendly pharmaceutical representative. But the question is, do they recommend a clear future economic benefit? This part not so much. You see, for doctors, medical practices are changing all the time, and the information in these books can go out of date pretty quickly. Books that are over 10 years old may contain some misleading information, so you can't really sell them, can't really use them, and you probably couldn't even give them away to medical students because they're out of date. So we say therefore that these books have essentially no future economic benefits, and thus they will fail the definition of being assets. We have a thing, but we don't have an asset that we can write down on our balance sheet. Next, we're going to review the recognition criteria. And again, if our thing fails at this point, then we won't be able to count it. For an asset, it must be probable that we're actually going to receive that future economic benefit and that it can be reliably measured. Probable just means that there is a greater than 50% chance that the firm will actually receive the benefit. So gold bars meet this definition because somebody out there will definitely in future be willing to buy those gold bars. But if you were to buy a lotto ticket for this Sunday's big jackpot draw, well, we wouldn't bother counting it. You see, there's an absolute minute chance that you're actually going to win that jackpot. And let's face it, there's not even a greater than 50% probability that you'll even make your money back. Reliability means that you're going to do the same thing again and you'll get roughly the same answer. But notice here that this does not mean the same thing as being accurate. Now, if you actually read the accounting standards, nowhere do you find the word accurate. This is kind of funny because most people stereotypically think of accountants as being exacting and accurate people. But it turns out that when you're trying to find the true value of something, sometimes accuracy is pretty much impossible. Say, for example, you have to value the land on which your business sits. You look at the recent nearby sales and consider the features of that land before deciding that the land is worth a little over $2 million. But how do you know if it's really worth $2 million? Well, the only way that you could be really sure that it was worth $2 million would be to sell the land. But then you don't have the land anymore and you can't use it for your business. But if you were to get an independent land valuation from a surveyor, you make a judgment and also the auditor checks off on that valuation, then that's these three sets of people, all of which more or less concur. And this means that it's much less likely that any one person there has been wildly inaccurate or even terribly biased. Again, it's reliable, but accurate? Harder to say. Okay, so that was a lot of work and we've only just gotten through assets. Let's move on to liabilities. Conveniently enough, the definitions are actually pretty similar to the assets. Pay attention to this
video because it's very important, because everything we do from this point onward, the statement, the balance sheet, the statement of comprehensive income, the cash flow statement, all these things that we are going to study this week and the next 2 to 3 weeks is based on these fundamental concepts. So if you don't understand this, you're going to struggle in the next couple of topics. Okay, so that is the reason I wanted to touch base on this. So everybody pay attention and follow what this person is saying. Philip is a good friend of mine and he's been a lecturer who worked under me for about 2-3 years. Okay, so he's a great guy and his presentation is pretty good.
Definition is found in paragraph 49B of the conceptual framework, and it says, a liability is a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. Again, there are 3 key parts. 1. A present obligation. 2. Result of past events. 3. The outflow of economic benefits. A present obligation means right here, right now, you owe somebody something. Usually money. Not that you did owe, not that you will owe. No, I mean that you owe money now. Sure, you might not actually have to pay anybody until some point into the future, but right now, you do owe somebody something. Past events, well, that's exactly the same as assets. It's pretty easy. And the outflow of economic benefits usually means that you're going to have to pay somebody or do something, or somehow it's going to end up costing you money. So let's say in your business that you make a mistake and you accidentally publish something on your website that's false, and it makes somebody in the community look pretty bad. So naturally they decide to call their lawyers and sue you for defamation. But before you go to court, they give you the opportunity to publicly apologize. You can retract the comments and you can correct them with a statement for the public record. In this case, you have the option to actually settle the debt with a sorry rather than having to pay out money, in which case it is no longer the outflow of future economic benefits. Thus, there's no liability recorded. Now, next we have the recognition criteria, which is almost exactly the same as assets. The liability has to be reliably measured and you will probably have to pay for it. Pretty simple. Moving on to equity. Now, equity does not actually have its own independent definition. Instead, it's simply defined as being the residual. Literally, it's assets minus liabilities is equal to equity. Now, for accounting students, this is great because it means you do not need to remember another definition of equity since, well, it's already based on the definitions of assets and liabilities. Just one less thing to remember. Now you'll note in my depiction here that the black equity is actually less than the assets minus the liabilities. And that's because this year's profit will be included in the equity as retained earnings when we make balance day adjustments. Now, we'll come back to these ideas in a later episode. Moving on to income. Now, both income and expenses are defined by how they affect the net equity of the firm. So, found at paragraph 70A, income is the increase in economic benefits during the accounting period in the form of inflows or enhancements of assets or decreases of liabilities that result in increases in equity other than those relating to contributions from equity participants. Okay, that was a bit of a mouthful, but it's not that hard when you think about it in terms of double entry accounting. Let's make it super simple. Income is an event that makes your firm a little bit richer. Expenses are events that make your firm a little bit poorer. So how does the firm get a little bit richer? Either assets can go up or liabilities can go down. Or, in accounting speak, income is a credit, so the other side of the journal has to be a debit. It can't be an expense since this would just net out the income. So it's going to be a debit to either an asset or a liability. Debiting the asset will push it up. Debiting a liability will push it down. The balancing item is simply called income, or the value that has come into the firm. Basically, the firm gets a little bit richer. Notice that if you were buying a new asset, this usually doesn't make the firm richer, at least not right away. If you're buying a brand new computer for your business worth $1,000, you've essentially just swapped $1,000 of cash for $1,000 of computer, but the net equity of the firm hasn't really changed. It really is that simple. And of course, an expense is simply the reverse. Basically, some bad event happens such that it eats away at the overall value of the firm, either by decreasing an asset or increasing a liability. Either way, the journal will have a credit to the balance sheet accounts, and this will result in a debit to the profit and loss report, basically an expense. Now, there is also recognition criteria for both income and expenses, and namely that they be measured reliably. There's no need to worry about the probability here since you're certain that the event has in fact already happened. Definitions! Easy stuff indeed, and you must know them. It's embarrassing when you meet young accountants and they can't remember what an asset really is. I mean, if you met a carpenter and they struggled to explain what a hammer is, you'd be pretty worried. So you must know your stuff. It's that fundamental. Today you learn the definitions of the 5 elements of accounting. These definitions actually include both the definition of the item itself plus a recognition criteria. The most important are the definition of assets and the definitions of liabilities because the other 3 elements are derived from these first 2, meaning there really isn't that much to remember. And most importantly, you learn that these are really important to commit to memory. My name's Philip Wong. I hope you've enjoyed watching. Happy studies, guys.
So I hope that gives you a very quick refresher of what may have already been covered. I'm sure Professor Charumati has fully covered most of these, but I just thought I'll do a refresher with you all so that, it helps you to get through to the basics that we're going to go through in the different statements, because everything is interrelated. Okay. So I'm going to quickly share the actual standards. Now, I prefer to go through the actual standards because then we are taking it from the horse's mouth, so to speak. So we are going directly into the actual standards. So in terms of the financial statement presentation, particularly for SMEs, the section explains fair presentation of financial statements. Okay, what the compliance of IFRS for SMEs. So what do we mean by a fair presentation? Fair presentation means that you give a true and fair view of the activities of the organization. So this could be, there are a number of different documents that we talk about. We talk about the statement of financial position. The statement of financial position is the first part of the equation I talked to you about. So it is assets equals liabilities plus owner's equity. And that's exactly what the financial statement of financial position is about. Then we have what we call the financial performance. The financial performance is the second equation I talked about, where profit equals income minus expenses. So that is the second equation, and that is the second financial statement. The last one, the cash flow statement, is the cash aspect, how the cash has moved within an organization. Now, everybody asks sometimes, what is the most important statement? As an accountant, as a chartered accountant, as a CPA, my viewpoint is that the most important statement of any is, what do you think? I'm going to give you a chance to answer. What is the most important statement out of the lot? You can write it in the chat. Sorry?
Cash flow.
Cash flow. Why is that, Kiritika?
Sir, it tries to give the inflow and outflow, sir.
Sorry, can you repeat that again? It gives you the...
Sir, it tries to give the inflow and outflow wherein we can come to know the performance of the organization.
But isn't that already given in the income statement or statement of financial performance? Same thing? So how is it different? Anyone else?
So in profit and loss statement, that is a consolidated figure, but when it is about the cash flow statement, so that is, it will show us the distinctive figure about the income and expenses from the operation, income and money inflow and outflow from the
not necessarily, because the income statement will have all that. It will have the income from operational activities, income from financing activities, income from operations, investments, and other activities. So it will still cover. So what is the difference between the finance statement and the financial position and cash flows? That's not entirely correct, Prabhat. Sorry.
So the cash flow statement gives the net change in the cash. So it will show how liquid is the company.
Exactly. So Murali, thank you for that. So the difference is that the cash flows will show you the actual money or the liquidity of the company. Look, I have a very good friend who lives in Melbourne. Okay. He has about 8 houses. Okay. Eight houses, and he's worth about 10 or 12 million dollars. Okay. But do you know what he has for breakfast? A banana. And do you know what he has for lunch? 1 dim sim, which is something like 1 idli or 1 vade. Okay. And you know what he has for dinner? A roll. Do you know why? Can you guess why? Can anybody guess why? So his financial position is perfect. Millionaire. Financial performance, income statement, top notch, millionaire. Cash flow statement, however, what do you think? Is very low. because he has all these investments. So he's paying mortgages, he's paying this, he's paying that. He has very little money to actually live day to day. Okay. This guy is 55 years old at the moment, but so you see the situation, right? He's a poor cash manager. That's exactly, Pitam has said, poor cash manager, because but in one way he's good because he has all these houses, but on the other way, he doesn't have enough money to live or doesn't have sufficient liquid cash to live day to day. So this is a result of what we call the accruals-based accounting systems, meaning we recognize assets, liabilities, and we talk about income and expenses, even though they are not cash related. And that's what we call the accrual-based accounting system. Okay. And that can be very misleading at times if you don't look at the whole picture together with the financial, the cash flows as well. So that's why as an accountant, the first statement I always look at is the cash flow statement. If the cash flow statement is relatively positive, then we can go and visit the other statements. Okay. Do you understand? Is that clear? Okay. So we talked about in the video, we talked about the recognition criteria and we talked about the definition criteria. I'm not going to go through that again. So these two criteria are very important. Now I'll send you the link to the video. Okay. So you can have it and you can have a look at it. Okay. So you also need to make some additional disclosures when you're making. They are called the notes to the financial statements. Okay. We'll talk about that once when we are going through this particular set of discussions. Okay. So in terms of compliance with IFRS as SMEs, an entity whose financial statements comply with IFRS for SMEs shall make an explicit unreserved statement that it complies in the notes. Okay, that's one of the things that we need to do. Also, if there's a conflict with the objectives of financial statements, that also has to be noted in the notes to the financial statements. All right. So there are a number of things here in terms of compliance that we need to look at when we are doing this kind of exercise in terms of applying IFRS for SMEs in a practical context. Okay. So one of the most important things to consider is what I call the going concern. The going concern is the viability of the organization to continue the existence in the short, medium, and long term. Okay. Let me just have a quick look here. When management is aware in making an assessment of material uncertainty related to the events of conditions, they need to make a very clear conservative viewpoint of what they are doing. Okay, does that make sense? Meaning, when you are making a determination of the organization, you need to be conservative. Okay, you need to be conservative in terms of your decision making while you are doing such a calculation. So if you think that an asset is worth, if you feel that the asset is worth 10,000 rupees, but conservatively you want to put a lower limit, I'll rather go for the lower limit than the higher limit, if that makes sense. Okay. The frequency of reporting is another thing that we talk about. In most cases, the frequency of reporting is usually 1 year, and it should not be longer than 1 year. Okay. But it can be shorter. Sometimes some companies provide mid-year reports or quarterly reports. So that's up to the organization to decide. But a bare minimum is on a yearly basis. Okay. Consistency in presentation. So there has to be some consistency and comparability. So that means the previous year, we need to be able to compare with the current year as well. Okay. Comparative information, materiality and recognition and aggregation should also be possible, meaning we need to be able to compare and add up these different aspects of resources when we are making comparison of the different companies or within the same company against the previous year as well. Okay. Now, do you have any questions up to this point? Anyone? Do you have any questions up to this point? Anyone? Do you have any questions? Okay. No questions so far. All right. Good. So let's look at the complete set of financial statements now very quickly, okay? The first one I talked about is the statement of financial position. So the statement of financial position is a snapshot. Let's say if we take a photograph of a company's assets, liabilities, and equity, it's a static snapshot at a given point in time of the organization, okay? Let's take an example. Does anyone, any one of you like to talk about your financial position at this point? Anyone? Okay, I'll talk about mine, okay, in a very brief way. So my assets are, I have a car, I have a house. So those are assets, but they all have loans attached to it. So that is what, then the other side of it, the assets are worth, let's say 10,000 rupees. Okay, my car is worth 10,000 rupees. Let's say my house is worth 20,000 rupees. So 30,000 rupees on the asset side. Okay. On the other side, out of that 30,000, I probably own $28,000 to the bank. Okay, or rupees. Let's say 28,000 rupees to the bank. So what is my liability? 28,000. What is my equity?
Yes.
What is my equity? 2,000 rupees. Okay, so you can see there, that is a very simplistic example of what a statement of financial position, or what we call a balance sheet. Okay, so a statement, so that's the first one. Okay, that's the first of the three statements that we are very concerned about, or very important for us to understand. The next one is what we call the statement of comprehensive income. Another statement, there are two ways to call it, okay? You can call it either an income statement, or you can call it statement of comprehensive income, okay? There's very little difference between the two, and they both usually meet the same objectives in terms of its implementation. So it says here, a single statement of comprehensive income for reporting period displaying all items of income and expenses, etc. And sometimes they do a separate income statement and separate statement of comprehensive income for each of the entities. So this doesn't apply to SMEs in most cases. It's much easier. Even large organizations, they usually tend to do one large statement of comprehensive income. Okay. Right. Last but not least, the other two important statements. So there's altogether 3 key statements plus 1 extra. Okay. So if you are looking at a holistic view, we talk about 4 financial statements. Okay. But basics, there are 3. But I'm going to talk about the 4 because we are looking at the complete picture. The fourth one is the statement of change in equity. So how did the equity change within a year? So I'll give you an example. So my snapshot, my balance sheet example I gave you was last year. Okay. From last year to this year, I paid back the bank another 2,000 rupees. So now what has happened? My assets remain the same, 30,000. My liabilities has gone down by how much? 2,000 rupees. So how much is my equity now? 4,000 rupees. Yeah, do you agree? So the equity has changed from last year to this year. So there is that change. So that is what we capture in what we call the statement of change in equities. The cash flow statement is how the cash, the actual physical cash, comes into the organization and leaves an organization. Okay. Does that make sense? Any questions? Any questions? Is this clear? If not, I'm happy to take it a little bit further, please. Any questions? Yes or no? Come on, you can type.
No, sir.
Okay, very good, very good. Okay, very good. So let's move on, okay? In some cases, there's also something called a statement of income and retained earnings. So that is another form of comprehensive income, which also includes the retained earnings. Retained earnings is what you call the profits of an organization, okay? So let's move on and let's look at identification of the financial statements. An entity shall clearly identify each of the financial statements and the notes and distinguish them from other information in the same document. Okay. Now I've given you already an assessment task to do with the CIPLA annual report. Professor Charumati, have we released that yet, or?
We are yet to release, Professor. Can I release in the Google Classroom?
Yes, you can do that. Yes.
Okay, today I will do that.
Okay. So if you look at that, one of the things I want you to pay attention, this is not in relation to the assignment, but this is in relation to today's class. When you download the CIPLA annual report, as we discussed, which where your assignment 1 is based on, when you download the CIPLA, I want you to go through their financial statements and look at their financial statements and also look at their notes to the financial statements. They've clearly highlighted saying, okay, this is the balance sheet, this is the income statement, this is the cash flow statement, and this is the change of equity statement. They've clearly labeled it and they have notes provided saying these are the notes to the financial statements. Very clearly labeled. So that is adherence to the IFRS framework, okay? Presentation of information is not required by this standard because SMEs are less governed, but there are some aspects that are not required. For example, segmentation information, earnings per share, interim financial reports, and things like that are not necessary for SMEs. So they are not necessarily required, whereas in big companies, you will have them. In SMEs, IFRS for SMEs, this is not as required as per the main one. Okay. Now let's go through the statement of financial position very quickly. Okay. So the statement of financial position has a number of items: the cash and cash equivalent, trade and other receivables, financial assets, inventories, property, plant and equipment, investment properties, depreciation and impairment, fair value and profit or through profit or loss, intangible assets, biological assets, and all these other things, investment associates, jointly controlled entities, and so forth. Then on the other side, we have the financial liabilities, liabilities of assets for current tax or the current tax liability, okay? Deferred tax liability and deferred tax assets, provisions, non-controlling interests. So all these activities or all these other elements are incorporated into the statement of financial position, or what we call the balance sheet. Okay. Now, the entity shall present additional line items, heading and subtotals in the statement of financial position when such presentations is relevant to an understanding of the entity's financial position. Okay. So you can see here the relevance of it as it comes through. Current versus non-current distinctions. The entity shall present current and non-current assets, current and non-current liabilities, and separate classification of statement of financial position in accordance to the paragraphs as noted there. So what they're saying is that you have to be very clear in the balance statement. What are the current assets? Current assets means the assets actually within a year. Okay. Non-current assets are some things that will take more than 1 year to convert into cash. Is that clear? Okay. Similarly, current liabilities are something that you need to usually pay within 1 year. Non-current liabilities are ones that are beyond 1 year. For example, my home loan is a 25-year home loan. So that is a non-current liability. Okay. Whereas my electricity bill, which is due in 2 months, is what I call a current liability. Okay. Any questions there?
No.
All good? Brilliant. Okay. Sequencing of items and formatting of items in the statement of financial position. Usually we put the current assets first and the non-current assets later. Current liabilities first on the other side of the statement, and non-current liabilities afterwards. Okay. So that's to give you an idea of these, how you present it. So the judgment of additional items are based on, excuse me, the nature of the liquidity of assets, the functions of the assets or liabilities within the entity, the amounts, nature and timing of the liabilities as well. So this applies to both assets and liabilities. So you need to think through, and how you present this is based on the timing, the amounts, and the nature of each of the assets and liabilities and so forth. Information to be presented either in the statement of financial position or in the notes. So there are some items, for example, what we call contingent liabilities and things like that. We can, depending on their probability, we may put them in the statement or we might put them in the notes. An entity shall disclose either the statement of financial position or in the notes the following sub-classifications: property, plant, and equipment in classifications appropriate to the entity; trade and other receivables showing separately amounts due to for related parties, amount due from other parties, and so forth. So if you're not sure of whether something really belongs in the financial statements, then you add that in the notes. Okay. Also, an entity with share capital shall disclose the following either in the statement of financial position or in the notes: number of shares authorized and some other relevant aspects in relation to the specific shares. So I'm not going to go through in detail all of these items, but I encourage you to download the standards, SMEs for IFRS, IFRS for SMEs, and then go through this document one by one in your own good time. Okay. So the next one that we are going to look at is the statement of comprehensive income, and or what we call the income statement. So the income statement, in terms of its presentation, is a single statement of comprehensive income, in which case the statement of comprehensive income presents all items of income and expenses recognized in the period. I would prefer to go with that definition. I'm not going to touch too much on the income statements for individual areas, because then that's not as relevant to an SME as it is to a large organization. Okay. Single statement approach is considered the best way to go. Okay. Under the single statement approach, a statement of comprehensive income shall include all the items. So this includes gains, losses, foreign operations, fair values, hedging instruments, property, plant and equipment, surpluses, and so forth. Any revenue that comes in, any expenses that go out, everything is incorporated and included in this particular statement. Okay. So we have revenue, finance costs, we have jointly controlled entity assets that, any profit or losses that arises from assets. Okay. Tax expenses, any other costs or losses from discontinued operations, post-tax gains, and there's a whole list of items here that is listed out, which are relevant to be listed under the comprehensive income statement. Okay. Entity shall disclose separately the following items in the statement of comprehensive income as allocations for the period. So we have non-controlling interest and owners of the parents, which either has a profit or loss from those entities. Total comprehensive income for the period attributed to non-controlling interests, owners of the parent. So it's everything. Any income or expense, either the parent company or subsidiary is incorporated. So in SMEs, the subsidiary aspect is very low. So you won't have as many subsidiaries, but there are in some cases, some organizations which have subsidiaries, which are SMEs, but they are called large SMEs. So then in some cases, when you have large SMEs, they have to kind of adhere to the full IFRS. Let me just get my jacket off if you don't mind. It's about 16 degrees here today, but it's relatively warm inside the house. So I'm just going to remove my jacket. All right. Right. So I'm not going to do too much on the two statement approach because that is not as relevant. Requirements applicable to both approaches is that they have to obviously follow the standards. You have to be clear about what the income and the outflows are. Okay. And also you need to adhere to the notes of the financial statements, which are at the bottom or at the end of the financial statements. Okay. Also, when you're analyzing expenses, you need to be able to clearly analyze the nature of the expenses. You also need to talk about the function of the expenses, the nature of the expense. For example, there are different expense types. There could be depreciation, purchasers of materials, transport costs, employee benefits. All these things have to be separately identified in terms of their nature. Okay. Also, the function of the expense. How did we incorporate this? Is it the tax or is it something else? Cost of distribution, administrative costs. All these things also have to be taken into account. Okay. Statement of changes in equity and statement of income and retained earnings. Scope of this section is to talk about how the earnings, the equity change based on the income statement. So the purpose of the statement of changes in equity is to show how the profit and loss of an organization affects the equity of that particular company. So the information to be presented in the statement of change in equities is the total comprehensive income, which comes out of the income statement, which adds to the equity of the organization. Okay. So it shows the carrying amounts of equity at any given point in time and how the equity changed in the given financial year. So there's also this concept of statement of income and retained earnings. So retained earnings is the part of the profit that is not distributed as dividends to its owners. So it is reinvested in the company. So that is what we call retained earnings. In other words, we keep the earnings to ourselves, or in the company's viewpoint, the company keeps that money so that they can reinvest in their business to grow their business. Does that make sense? All good? So information to be presented in the statement of income and retained earnings is retained earnings at the beginning of the reporting period, dividends declared, statement of retained earnings for correction in the prior years if there are any errors, statement of retained earnings in the changement of accounting policies that may have happened, and end of year reported retained earnings. Okay. Any questions up to that point? All good? Okay. Now I watch a video very quickly. Okay, can you see this video?
Yes, sir.
Okay, good. Can you hear the music when I played it earlier? Okay.
I'm Chris Higson, and I'm a professor in the accounting group at London Business School. In this series of podcasts, I'm going to be talking about some of the big global financial issues. But in this podcast, I'm going to give an overview of financial statements. Let's start by thinking about what we need. Financial statements are our window into the corporate world. They're the only window we have. So we have to make them work. We use financial statements to measure the profitability of companies, to figure out why companies are profitable and whether that profitability is sustainable. Equally, we use financial statements to measure the financial strength of companies. We want to know how much equity capital there is in there and how much borrowing the company is doing. So all of that gives us an accounting model. We need companies to provide a balance sheet that's complete in their assets and liabilities and is valued at current values, or more precisely, that measures the opportunity cost of those assets and liabilities. And we need an income statement that measures income comprehensively. The good news is that GAAP, that is IFRS, US GAAP, the accounting rules that determine what should go into financial statements, GAAP gets the model. GAAP has made big strides in recent years in giving us the balance sheets we need. Yes, balance sheets are irrevocably at historic cost. And it's true that they are never going to show the very valuable intangible assets that some companies have. But we can live with both of those things as long as we understand it. GAAP now makes companies tell us very clearly the so-called OCI of the business, the other comprehensive income. That is the profits and losses that bypass the income statement altogether. And for some companies, the amount of traffic going through OCI is quite extraordinary. So again, the data is there for us to use. We must make sure we use it. I conclude that in terms of accounting model, GAAP is in pretty good shape. The problem isn't the model, it's the level of detail and disclosure that we need around that model. And this is something you cannot easily legislate for. Companies come in all shapes and sizes, and it would be impossible to legislate for the particular disclosure that you need from each different beast in the corporate jungle. So instead, you rely on top management to embrace the principle of disclosure, and of course, you rely on the auditors to police and enforce it. There are a number of areas where we're not getting the detail we want. Let's take just one example, which is segment disclosure. In any company of some size and complexity, what we'd ideally like is the accounting model for each of its main segments. And GAAP has the right idea. The GAAP principle is that companies should disclose the same segments that top management use for measuring performance internally. But we're clearly not getting that. We can look at the financial statements from some large, reputable companies, and we just cannot believe that management are monitoring internal performance at the high level of aggregation that we're seeing in segment disclosures. Clearly, the principle of segment accounting is not working in practice. Also, we have relied on demand leading supply. That is, we've relied on companies producing financial information in response to the demand from investment analysts. 10 or 15 years ago, equity analysis was a very well-funded industry. And as a result, all stakeholders were able to take a free ride on the output of investment analysts, funded frequently by the big investment banks. That golden age is now over. Many small and even medium-sized companies have very limited analyst coverage, and perhaps as a result, their financial statements are limited on disclosure and frequently quite opaque. And many companies are abandoning public equity markets altogether and going private. Americans have a particularly graphic phrase for this. They call it going dark. In the US, the loss of information when a company goes private is particularly sharp because there is no legal requirement from the SEC to publish accounts under GAAP at all if you're a private company. With hindsight, we might look back at the 20th century as the high point of public market capitalism. We have to make sure that it's not correspondingly the high point for financial disclosure and financial reporting.
That gives you a very interesting viewpoint on financial statements, isn't it? What was the key message that you learned from the video? What do you think? What do you think was the key takeaway? Anyone?
So they show the financial strength of the company.
What else? He also talked about a number of important things to SMEs. He said that not all statements I mean, each company is different. So each company, depending on their requirements, they need to kind of adapt the financial statements to their own requirements. Isn't that the case? Yes or no? To a within the standards, of course. Yes. And complexities of disclosures, how companies are, and private versus public companies. So all these things were discussed. Okay. So keep that in mind, and we'll go to the next section. I know we are slowly running out of time, but I'm going to finish the last section, the statement of cash flows, and then we can stop for the day. Okay. Right. As I said, this cash flow statement is the most important statement in my view, because that really shows a company and its true form. Okay. So the statement of cash flows has anything that relates to cash or cash equivalent of an entity for the reporting period, showing separately changes from operating activities, investing activities, and financing activities. Okay. Cash equivalents. Cash equivalents are short-term, highly liquid investments that are readily convertible to known amounts of cash. For example, gold, platinum would be something that you can directly convert into cash quickly. Okay. Inventory would be another one. Okay. That you can convert very quickly. So all these things are what we call cash equivalents. Okay. Information to be presented in the statement of cash flows are operating activity statements, investing activity statements, and financing activity statements. So operating activities talks about your actual cash flows from operations, meaning the company operations, meaning what the company does at its core. What is the company about? Investing activity is where the company invests money in other areas, and profits and losses, cash related, that comes from that. So the cash that comes in from investing and the cash that goes out to investing. Financing activities is where the company gets its money from, its cash from. Bank overdrafts, bank loans, where they get physical money from these institutions. Okay. So reporting cash flows from operating activities, there are different ways of doing it. We talk about the indirect method and the direct method. So under the indirect method, the net cash flows from the operating activities is determined by adjusting profit and loss for the effect of the changes during the period, and non-cash items such as depreciation, provisions, deferred tax taken out of it. The direct method, on the other hand, talks about the net cash flows from operating activities presented by disclosing information about major classes of gross cash receipts and gross cash payments. Such as information may be obtained from accounting records. So primary documents, something that comes out from primary documents, from first-hand documents. So periods of inventories, operating receivables and payable, other non-cash items are all taken into consideration if you have some documents in terms of the direct method. Reporting cash flows from investing and financial activities. And then we have the foreign currency cash flows, which also need to take into account any foreign currency translations, any money gained or lost in changing from rupee to a dollar, dollar to rupee, and so forth. Okay. Interest and cash dividends paid, income tax, money paid, and non-cash transactions that are equivalent to cash flows shall also be noted in some cases. Okay. So components of cash and cash equivalents, an entity shall present the components of cash and cash equivalents and shall present a reconciliation of the amount presented in the statement of cash flows to the equivalent items presented in the statement of financial position. So you can see here that the flows and details that need to be put in. Any questions so far?
In chat box, I think Kritika
Yes.
Devi has asked
So
one
gap
question.
analysis is giving a clear view. How gap analysis is giving a clear view. In what context are you referring to, Kiritika? What do you mean by gap analysis?
I think she's in BF from paper also. There I taught that gap. This is generally accepted accounting
Principles, yes. So what are you referring to in terms of this one?
Kritika, can you?
Sir, video was known, sir. Actually, the video what you played, no, in that the professor said about this gap analysis.
Yes. So what he's talking about, okay, in that context, if you're looking at it that context, what it's trying to say is how closely does the gap principles, GAAP principles, how closely are they followed in the financial statements will show the quality of the financial statements. If you take two financial statements, they could both follow the basic guidelines of the standard, but one would be far superior quality than the other. Why? Because they may be following gap more closely than the other. So that is where the gap analysis comes through, where you can analyze how closely an organization applies the general accepted accounting principles in a more clear way. So conservatism is one of them. Okay. Do you get it? Do you understand? I touched on this a little bit earlier, where you have two options. Are you going to put in 10,000 as the figure, or are you going to put in 8,000 as the figure, or 6,000 as the figure? So that is again showing the quality of the report. If you're conservative, that shows the quality. That's referring to gap in a very clear manner. Timeliness is another one. So all these things are taken into account when you're looking at it from that perspective. Does that answer your question?
Yes, sir.
Okay, very good. So I think I will stop it from here. I will stop the recording now. Stop recording. Right. Professor Charamati, once the recording is available, I will email you the recording for record keeping purposes. Okay. But I think we covered what I wanted to. I wanted to cover the next section as well, but that was, I think, a little bit ambitious. I don't
next class also.
Yeah, I know. So I think I promised to cover 3 topics today. So I have actually done the 3 topics. So I wanted to do a 4th, but obviously time doesn't permit. But that's okay. That we can take it.
So we scheduled it in the next week, Prof.
Yes, that's right. Yeah, I was hoping to do a little bit more and then kind of keep the flow going. But that's okay.
Yes.